So in this video today, we are going to be talking about the 10 stocks that have paid and grown their dividends the longest. And this is a category of stocks referred to as Dividend Aristocrats. But in particular, what I want to look at is the 10 among this highly sought after list that have paid and grown their dividends for well over 50 years. And the reason why we're covering this now is due to the economic uncertainty right now. A lot of people are looking for safe investments. And let's talk about dividends a little bit before we get into the video, or if you're already familiar with them, I'll leave a link in the description where you can fast forward and get right to the stock picks. But if you're not familiar, dividends are regular cash payments paid to shareholders who own a particular stock, and not all stocks out there pay dividends. You often have two categories of stocks. You have growth stocks, and those are up-and-coming companies like Uber and Lyft, for example, that aren't making a lot of money just yet, or they're not profitable, but there's a lot of growth potential for that company. And then you have these dividend stocks that are more well-established companies that don't necessarily have as much growth potential, but they do pay dividends as a way to reward shareholders and keep them sticking around. And essentially what these companies are doing is taking a portion of the company earnings and distributing it to shareholders in the form of a cash payment. And in most cases, this is done on a quarterly basis, but there are some monthly dividend stocks, biannual and annual dividend stocks, but for the most part, these cash payments come once per quarter, and those who reinvest those dividends are able to earn compound interest. So during times of economic uncertainty, a lot of people flee to these safe haven dividend stocks because of their long track record of paying and growing dividends. And right now, when we look at these top 10 dividend aristocrats, there are some that have sold off massively. We're talking 40, 50% or more, which could be a good opportunity to buy for a long-term hold. Now that being said, guys, I just have to make this disclaimer that I am not a financial advisor, and this is not financial advice, and this is just for entertainment purposes only. And also, one more thing I want to mention real quick here, guys. If you're looking to sign up for a brokerage account, Webull is running a promotion right now that's going to end at the end of this month, where if you sign up for a brokerage account with them, you will get 2 free stocks just for signing up and funding that account. I want to mention that quickly here for you because that promotion is ending at the end of this month, so you have just a couple days left to take advantage of that if you want to sign up and get your 2 free stocks. But that being said, guys, let's talk about these dividend aristocrats. And in order to fall into this category, this means you are a dividend paying stock that has consistently paid and grown the dividend for 25 consecutive years or more. And of all the different companies out there that pay dividends, only 64 high-quality companies fall under this category of being a dividend aristocrat. But we're going to focus on the top 10 of the top 64 and look at what companies have paid dividends and grown them the longest, and whether or not these are good investments at this particular time based on what is going on with the overall economy. So that being said, guys, let's jump into stock number 10 and work our way down to the company that has paid dividends the longest. So coming in at number 10 is a company that I'm sure we've all heard of before, or we have at least used the products, and that is the ColgatePalmolive company. And they have an impressive dividend growth streak of 56 years. They've consecutively paid and grown their quarterly dividend. Now, ColgatePalmolive is a household essentials company, and obviously the name suggests what their 2 largest brands are, which is Colgate and Palmolive. But there's a lot of different brands that this household company owns that you may not be familiar with. Now, they are primarily a health and personal care company, but a lot of people do not know this. They're also a veterinary care company through a popular dog food brand that they own called Hill's Diet, which, if you're not familiar, guys, that's a very high-end pet food. I think you can only buy it at your vet, and it has special use cases based on, symptoms your animal is experiencing. So you get a diversification here of household products, healthcare products as well as vet-related products. So you're involved in multiple different industries that see healthy demand regardless of the underlying economy. Now, that being said, because this is such a recession-proof industry, the stock has barely budged. If you were solely looking at Colgate-Palmolive stock and you were asking yourself, are we in a recession? Are we in a stock market crash? You would have no idea because the stock has barely moved. It has not moved lower like a lot of these other ones have. And so as a result, you haven't seen much of a dip in that share price at all. But that is because this is a durable, recession-proof investment that investors are flocking to during these times of uncertainty. So let's talk about a couple of the brands owned by Colgate-Palmolive. As far as household care goes, they have Palmolive, they have Murphy Oil, they have Ajax, they have Pine Sol. For personal care products, you're probably familiar with Colgate, as well as Soft Soap, which is a big seller right now. And they also have the Speed Stick deodorant line. And then, like I said, in the veterinary products category, they have the Hill's Diet pet food, which is a very high-end, expensive pet food that typically comes right from your vet. And the point here, guys, is that these products that Colgate-Palmolive sells are things you buy regardless of the underlying economy. Whether or not we're in a bull market or a bear market or a recession, we're all going to buy toothpaste. We're all going to buy deodorant. And if our pets need specific dietary requirements and special food, well, people put their pets before just about anything out there. So you better bet they're still going to be spending their money on the Hill's Diet pet food. This makes this a very safe recession-proof investment. As far as the dividend goes, they currently pay a dividend of 44 cents per share, giving them a dividend yield of 2.58%. All right, moving on to number 9, we have a healthcare giant, one of the highest quality companies that money can buy, and that is Johnson & Johnson with a 56-year dividend growth streak. And if you're not familiar with this company, guys, Johnson & Johnson was founded in 1886. They make medical devices, pharmaceutical and consumer packaged goods. And of course, right now, this is a stock that people are again flocking towards because of the underlying economy and the virus that's spreading. They know that a company like Johnson & Johnson is positioned to do well regardless of the underlying economy. And again, the largest business here for Johnson & Johnson is the pharmaceutical business. So as a result, even if people do not have the money to go travel, or if they don't have the money for restaurants or whatever it is, they're still going to spend money on the pharmaceutical drugs, which again makes this a recession-proof investment. Now, this is what you refer to as a medical giant. They have a market capitalization of $350 billion. And just like Colgate-Palmolive, the stock has barely budged during this stock market crash. If you take a peek at Johnson & Johnson stock, guys, it was trading at around $150 per share, and now it's down to a whopping $130. It literally has barely sold off during the stock market crash that we're seeing right now, and they're around a 1-year low, which may sound like a lot, but we are currently seeing companies at 15-year lows, depending on what industry you're looking at. So for a stock to be at a 1-year low, it has barely budged because people are flooding into this stock. The other thing to consider here is that the demand for consumer products has surged for Johnson & Johnson as more people are out there purchasing things like medical gloves, first aid supplies, and hand sanitizers. So they are in a position where they are probably going to do pretty well here during whatever we have going on in the coming months. Now, this is a great, durable, time-tested, recession-proof investment, and as a result, it is very unlikely that we will see this company go on any kind of sale. As far as the dividend goes, they currently pay a dividend of 95 cents per share, which gives them a dividend yield of 2.93%. Okay, moving on, number 8, a stock that I may or may not have just added to my portfolio, and there's a couple more that I have as well, or maybe not. We'll see in my next update. But that is Lowe's stock. It's a hardware company. It's a household name that we're all familiar with. And this company has paid and grown their dividend for 58 years, especially in a struggling environment for retailers. Now, this tends to be a somewhat recession-proof area as well because people are going to need to make repairs to their home whether or not the economy is good or bad. But the other side of the coin here is that a lot of people spend money at Lowe's on household projects that are more discretionary, remodeling or putting in a new patio or buying a new grill. And if people do not have money, they're going to cut back on these discretionary purchases, but you should always see a good amount of healthy demand here for Lowe's for people simply making repairs to their aging homes. So because of that, it's not totally recession-proof, and it has sold off, baby. Let me tell you. The stock symbol is low, and that is a good indicator of what the stock is doing. It is very low right now, down about 50% from where this stock was trading at earlier this year. Now, Lowe's operates over 2,200 different stores in the US and Canada, and one of the biggest things they're up against right now is the changing retail environment where more people are purchasing online, and that's what they're investing a lot of their money into, is the e-commerce side of their business. Despite the changing retail environment, they've grown dividends for almost 60 years consecutively, and in my opinion, this seems like a great opportunity for a long-term position if you want to own a retail company that's really not at major risk of going under or going bankrupt. Because while less people are spending money at clothing retailers and things like that, we still go to Lowe's, we still go to Home Depot, and many of us will continue to do so even if we're shifting to more online ordering. Now, Lowe's currently pays a dividend of 55 cents per share, but thanks to the fact that they fell about 50%, that is now paying a dividend yield of 3.42%, which in my opinion is quite appealing. All right, moving on here to number 7, we have a company that everybody has likely heard of. That is Coca-Cola, and this is another Dividend Aristocrat that has paid and grown dividends for 58 years. Now, a lot of companies on this list have been paying dividends for even 100 years or more, but to be a Dividend Aristocrat, we're strictly looking at how many years that dividend has grown consecutively. This is another stock that I did just add to my dividend investing portfolio. And if you guys want to check that out, I will link up down in the description below. I am building a dividend stock portfolio from scratch, updating you guys every single month on the progress. Now, Coca-Cola is one of the most well-known brands in the world, up there with the likes of companies like Apple. And essentially what they are is a manufacturer, marketer, and retailer of non-alcoholic beverages, concentrates, and syrups. And Coca-Cola is like the first stock that people buy when they begin investing. If you're a complete beginner, most people will say, hey, buy some Coca-Cola stock because it does nothing, and these boring investments are great during times of uncertainty. But the kicker here is this stock has actually sold off massively, and you rarely ever see a stock like Coca-Cola going on sale. This used to be a $60 stock any day of the week, and it's now trading in the range of around $40 per share. So I decided to, get into Coca-Cola, start a position with them, and I'll update you guys in my portfolio update, but you're getting a little sneak peek here now of some of the new additions to my portfolio. This is the longest held investment by Warren Buffett, and it's for a reason. He's a big fan of Coca-Cola and the company. They have over 500 brands in their portfolio across 200 different countries, giving you global market exposure. And one thing they're up against right now is the change in consumer purchasing of sugary beverages. But like we just said, they have 500 different brands in their portfolio, so they do have sparkling waters and different waters and sugar-free beverages or low-sugar options that people are purchasing instead. As far as the dividend, they pay a dividend of 41 cents per share, currently paying a dividend yield of 3.90%. All right, number 6 is a company you've probably never heard of before unless you study these Dividend Aristocrats. And in terms of the size of these different companies, we just talked about Johnson & Johnson having a market cap or market value of $350 billion. And now we look at this small company called Cincinnati Financial that only has a market cap or value of $15 billion, making this a much smaller company. Despite that, Cincinnati Financial has grown their quarterly dividend for 59 consecutive years, coming in at number 6 on our list here. And the name is a little bit confusing, Cincinnati Financial. They are involved in investments, but they're not a bank. They are actually an insurance company that has different types of personal liability and business insurance for a variety of customer needs. And it's one of the most boring industries you can think of, but it's very consistent and another recession-proof industry. And the other thing to consider here is that during times like this, when people are fearful, insurance is an easier sell. When people are worried about, hey, when I don't have money coming in, how is my family going to stay afloat? Life insurance is a much easier pitch right now in times of fear and uncertainty. Now, this stock has basically kept pace with the overall market in a sell-off. They're down about 30%, and I personally don't know anything about the insurance industry, probably not one I would get involved with, but it is one you can have on your radar if you're researching some quality dividend stocks. As far as the dividend goes, they currently pay 60 cents per share, giving them a yield of 2.91%. Moving on to number 5 on our list is a company that I've been buying for the last couple of months. I am down quite a bit right now, but I'm focusing on 5 years out with all of these investments. That is 3M with a 61-year dividend growth streak. Now, 3M is a conglomerate, which means a company that owns many different businesses, and there are multiple different brands under that name as well. And essentially, 3M is just this diversified company that has all kinds of different products that serve pretty much every industry out there. And these products serve different industries ranging from automotive parts to medical devices, the Post-its brand, Sharpies, cleaning products, and more. You name it, the industry, and I can guarantee you 3M probably has a product that serves that industry. And this is a portfolio of over 60,000 different products that 3M manufactures and sells. Now, the one issue with owning a stock like 3M is that because they serve all of these different industries, they are tied to a number of cyclical industries, such as automotive and manufacturing. So when they supply parts and as well as components for the automotive industry, for example, or buffing components, for example, you're going to see that demand shift based on the automotive market. So because of that, they are susceptible to the natural business cycles, and right now when we're seeing certain industries in retraction, it is going to negatively affect 3M. However, 3M is also poised to do very well in the short term as the largest medical mask supplier out there due to the spread of the virus. As far as the stock goes, this used to be a $220 per share stock, now trading at around $130. And again, guys, they have grown that dividend for 61 years, longer than probably most of us watching this have been alive. As far as the dividend, they currently pay a dividend of $1.47 per share, giving them a very attractive dividend yield of 4.31%. Moving on, number 4, another stock I just added to my dividend portfolio, the last one here of this bunch, and that is a company called Emerson Electric. Have you ever heard of it before? Probably not. If you have, drop me a comment down below. This company has grown their dividend for 62 consecutive years, and Emerson Electric is a company dating back to 1890 that manufactured fans and electric motors. But now Emerson Electric is a global technology solutions company and one of the leading companies involved with process automation. Now, we just talked about how manufacturing has been hit lately, and so Emerson Electric has gone into a sell-off as well because of the overall slump in manufacturing. A big part of their business is process automation, and when there's a slump in manufacturing, there's less demand for their engineering services. So this stock has taken an absolute beating, but it's interesting if you follow the news because hedge funds have been scooping up this stock left and right. The stock is trading at about a 40 to 50% discount, and the dividend is very attractive. 50 cents per share, giving them a yield of just above 5% right now in a high-quality blue chip company that has grown dividends for 62 years. Number 3 on the list, another household name that we've all heard of. Whether or not we know it, we'll probably use their products this morning. That is Procter Gamble with a 63-year dividend growth streak. And this is another giant company that owns countless brands that we all use every single day. Some of the most well-known brands are Tide, Olay, Pampers, Bounty, Charmin, Gillette, Old Spice, Cascade, Crest, and more. So if you want to capitalize on the toilet paper rush that people have, buying up all the toilet paper at all the stores, this company owns a number of toilet paper names, and they are poised to do well as a result. Now, the majority of the products that Procter Gamble sells fall under the category of consumer staples, making them a durable, recession-proof investment. Again, I probably sound like a broken record, but these are products we buy regardless of the underlying economy. Now, these investments tend to underperform in a bull market because you buy the same amount of toilet paper and toothpaste regardless of how much money that you have. If you get a bonus from work, during normal times, you're not going to run out and buy 10 times as much toothpaste. You're going to buy the same amount of toothpaste. Toilet paper, we're going to leave that out for now because people are freaking out over the toilet paper. But under normal circumstances, we all use the same amount of toilet paper unless we had Mexican the night before, but that's a different story. Anyways, guys, this is a company that has very consistent demand for their products, and as a result, you're going to see people buying the same amount of them. Whereas as far as, travel or restaurants, spending increases based on how much money people have. So they underperform in a bull market, but they hold up very well during a bear market. Now, Procter & Gamble is in a great position as well in terms of making more money because they have so many different products, and this honestly goes for 3M as well as ColgatePalmolive as well, because all they have to do is just turn up the dial slightly on some of their products, increasing prices incrementally, allowing them to make more money from rising prices across a diversified portfolio of different brands. As far as those brands go, Procter & Gamble has 65 different individual standalone brands, and despite the market tanking, because this is a safe haven investment, the stock has barely sold off. They're currently paying a dividend of 75 cents per share, giving them a yield of 2.6%. Number 2 is Genuine Parts Company. I added them to my portfolio a couple of weeks ago, and this company has a 63-year dividend growth streak. And if you've never heard of this company before, I don't blame you, but I guarantee you've probably heard of Napa, and this is the parent company that owns Napa, as well as a couple of different other businesses. Now, this is a company that's involved obviously in auto parts under the Napa name, but they're also involved with industrial replacement parts as well as different business products. As far as their revenue breakdown, 56% of their business is auto parts, 34% is industrial, and 10% is business products. So the majority of their money comes from the auto parts business. Now, why would you want to own a stock like this during a recession? Well, one of the first things people stop spending money on when they don't have money coming in is a new car. They drive their older vehicles for a longer period of time. And what happens when you drive a car for a long time? Well, things start to break on that car. So as a result, when people spend less on cars and own their existing cars longer, more repairs are made, and a company like Napa is poised to benefit from the sale of tools and hardware and parts for repairing your car. And this is because car parts in most cases are a need and not a want like discretionary spending. We all need reliable transportation, and at the end of the day, if something breaks in your car and it's going to affect your ability to make money, you're gonna figure out how to pay for that, and whether it's a credit card, borrowing money, who knows what, we all need reliable transportation, making this a durable, recession-proof investment. Despite that, I would imagine because of the industrial exposure, this stock has sold off pretty massively here. It was around $100 per share. Now it's in the $60 per share range. But as a result, the dividend yield is quite high. They pay a dividend of 79 cents per share, giving them a yield of 4.76%. Personally, I see this as a very attractive investment. You will have to do your own due diligence and make your own decision, but I like pointing you guys in the direction of stocks you may wish to consider and do your own research on. And then finally, number 1, what company out there has grown their dividend every year consecutively for longer than any other company? None other than Dover. Again, a company you've probably never heard of, but they have a 64-year dividend growth streak. Not gonna lie, guys, before making this video, I had never heard of this company before. Dover is another conglomerate, which is again a collection of many different businesses. Now, those businesses serve a number of different industries. They make labels for food and beverages. They also are involved in digital printing for other consumer goods. They make loaders for waste collection, you know, the big dump trucks that you see driving around. They also make commercial refrigerators as well as pumps for the transportation of fluids, including petroleum and natural gas. Now, because a big part of their business is relying on natural gas, oil, petroleum, this stock has sold off quite a bit, as many natural gas and oil companies have, because we have seen oil prices crash. So this stock is currently down somewhere in the range of 40 to 50%. And because much of their business is cyclical, driven by consumer spending, such as sale of refrigerators, that's going to be more popular when restaurants are opening, as well as labeling on consumer products. They are involved in some cyclical industries, so they're susceptible to the natural ebbs and flows of a business cycle. Despite that, guys, they have managed to grow their dividend every year longer than any other company out there. So it is one that you definitely want to pay attention to, and it's not one that you should sleep on just because you've never heard of it. They currently pay a dividend of 48 cents per share, giving them a yield of 2.81%. But anyways, guys, that is going to wrap up this video. These are the 10 stocks that have grown their dividends the longest, a number of which are a part of my dividend stock portfolio. If you want to check out that video, guys, I'll put a card in the corner. I'm building a dividend stock portfolio up to $100,000 of value from scratch and documenting it every month here on my channel. I'd love to have you guys check that out. And one thing I want to remind you here, guys, is that these dividend stocks are not going to be the highest yielding stocks, but that's because dividends themselves are never guaranteed. Companies can cut or eliminate that dividend at any point in time. So these aren't the highest yields, but they are the most sustainable yields that have grown over time based on varying market conditions. So we're not seeing 7, 8, 10% yield here, which you may see from other stocks, but that's often referred to as a dividend yield trap. People see the high double-digit dividends, they get suckered into it, then the company cuts or eliminates that dividend, and they're stuck bag holding a stock for years to follow. So you don't just look at the yield, you also want to consider how long has that company paid dividends and how long have they grown those dividends. The Dividend Aristocrats being a great place to start your search. But thanks so much for watching, guys. If you enjoyed this video, please drop a like and comment if you made it to the very end. I would love to hear from you. Subscribe if you haven't already. Hit that bell. That's all I got, and I can't think of any other plug here. Oh, wait a second. Yes, Webull, 2 free stocks, ends at the end of this month. You got about 10 days or so to do that. Thanks for watching, guys, and I'll see you in the next video.